Good day. We are the group composed of Christian Custodio, Robbie Jaworski, and Angela Mendoza, and we'd like to present our stock market game. The purpose of this presentation is to provide the rationale behind the investments made for this portfolio we made in the Investopedia simulator. Moreover, it will provide an overview of each of the companies we've invested in and the reasons why we chose to invest in them. The portfolio consists of 10 companies from various industries, including automotive or electric vehicles, e-commerce, technology, fast food, personal services, and energy. As seen in the table, these are the companies which we invested in, the shares bought, and the purchase price at the time they were bought. And here's Investopedia's overview of our portfolio as of today. TME, or the Tencent Music Entertainment Group, is a leading online music entertainment platform in China that provides a range of music-related services, including music streaming, online karaoke, and live streaming. TME's main competitors in the music streaming market in China include NetEase, Cloud Music, and Alibaba-owned Xiaomi Music. Both platforms have sizable user bases and offer similar services to TME, such as music streaming and social entertainment. However, TME maintains a dominant market share in China, and its strong partnerships with record labels and publishers give it a competitive advantage in terms of content. Outside of China, TME faces competition from global music streaming giants such as Spotify and Apple Music, which have both launched in the Chinese market in recent years. However, TME's focus on local content and partnerships with Chinese record labels and publishers have allowed it to maintain a good or strong position in the market. Because the company has a strong market position in China and dominant position in the online music streaming industry, we purchased 660 shares of TME at $7.64 per share on April 14, 2023. Compared to the peer average to the peer average price to earnings ratio of 58.5, 10 cents, or TME's price to earnings ratio of 23.3 is relatively low despite its performance. With this, we believe that the stock is currently undervalued. While in terms of risk, the company has a healthy balance sheet with low debt levels and strong cash flow generation, which reduces its financial risk. The company is also expected to continue growing its revenue and earnings in the coming years, driven by the increasing adoption of streaming music in China and the company's expanding user base. Li Auto Incorporated is a Chinese electric vehicle manufacturer that specializes in designing and producing smart electric SUVs. In terms of its competitors, Li Auto Incorporated competes with the likes of NIO, XPeng, and BYD. The company has differentiated itself from its competitors by focusing on the SUV market and offering a unique extended range electric powertrain design, which has a gasoline-powered generator and extends the range of the vehicle. We purchased 330 shares of this company at $22.6 per share on April 21, 2023, as we believe the company has strong growth potential due to increasing demand for electric vehicles in China and the company's unique technological capabilities. As the global push towards sustainable energy continues, demand for electric vehicles is expected to rise. Li Auto Incorporated is well positioned to benefit from this trend as it specializes in the development and production of extended range electric vehicles that offer a balance between electric and gasoline power. It's not only this, but Li Auto has a first mover advantage within the market in the extended range electric vehicle market, rather, in China, and has established a strong brand reputation for quality, innovation, and customer service. The company has also built a solid supply chain and distribution network that enables it to scale up production and expand its market reach efficiently. Lastly, the Chinese government has implemented several policies and incentives to support the growth of the electric vehicle industry rather, such as subsidies, tax credits, and relaxed regulations. This provides a favorable operating environment for the company and other electric vehicle companies in China. As far as valuations go, um, Li Auto's price to sales ratio is 3.5. Li Auto's price to sales ratio of 3.5 is relatively low compared to the peer average of 7.8, and the US auto industry average of 4.5. We believe that given its current performance, Li Auto stock is a good buy due to its undervaluation and strong growth potential in the electric vehicle market in China.
We purchased Etsy at the price of $111.01 per share, with 15 shares acquired. Etsy has seen significant growth in recent years, with a current P/E ratio of 82.45, which is higher than the industry average of 27.23. However, the company has a price to book ratio of 27.91, which is in line with its industry average of 28.37. Etsy has been benefiting from the e-commerce trend that has accelerated during the COVID-19 pandemic. With more people buying goods online, the company's revenue has increased by over 100% year over year in the past few quarters. The trend towards online shopping is expected to continue, and is well positioned to take advantage of this shift. Next, we move on to Amazon. Amazon was purchased at the price of $102.33 per share, with 30 shares acquired. Amazon has been a dominant player in the e-commerce industry for many years, and its recent expansion into other areas such as cloud computing and streaming services has only added to its potential growth. The company has a high P/E ratio of 69.62, which is higher than the industry average of 27.23. However, the price to book ratio of 16.46 is lower than its industry average of 21.16. Amazon's growth potential is supported by the trend towards e-commerce, which has accelerated during the pandemic. Amazon's revenue has increased by over 40% year over year in the past few quarters, and the company is expected to continue benefiting from the shift towards online shopping. Pinterest is a visual social media platform where users can create and share pins, create boards, and shop. Businesses benefit from using Pinterest through brand exposure and a wider potential customer base. Pinterest was purchased at the price of $27.03 per share, with 20 shares acquired. Pinterest is a social media platform that has gained popularity in recent years, particularly among younger users. The company has a current P/E ratio of 108.68, which is higher than its industry average of 43.60. However, the price to book ratio of 20.12 is in line with its industry average of 20.69. Pinterest has been expanding its advertising offerings, which has helped to drive revenue growth, and the company's revenue has increased by over 70% year over year in the past few quarters, and the trend towards social media is expected to continue. Visa is a well-established payment processing company that has been in the market for many years. This global payments technology company provides digital payments across more than 200 countries. We purchased Visa's shares at $224.11 with 20 shares acquired. The company has a current P/E ratio of 44.91, which is lower than its industry average of 53.18. Additionally, the company has a price to book ratio of 14.88, which is also lower than its industry average of 16.05. Visa has been benefiting from the shift towards cashless payments, which has accelerated during the pandemic. The company's revenue has increased by over 10% year over year in the past few quarters, and it is expected to continue to benefit from the trend towards digital payments. In addition, the company has a strong balance sheet with a debt to equity ratio of only 0.64 and a current ratio of 1.27, indicating that the company has sufficient liquidity to meet its short term obligations. Apple designs, manufactures, and markets smartphones, tablets, personal computers, and wearable devices. Apple also offers software applications, accessories, and third party digital content. Their signature products include iPhone, iPad, Mac, Apple Watch, Apple Music, and Apple TV. We purchased Apple stock at a price of $163.95 per share, with 15 shares acquired. This well known technology company has been in the market for over 40 years. The company has a current P/E ratio of 29.96, which is lower than the industry average of 39.90. Additionally, Apple's price to book ratio of 31.57 is also lower than its industry average of 51.49, indicating that the stock may be undervalued.
Regarding Daco New Energy Corp, or its ticker symbol DQ, the company has a trailing price to earnings ratio of 8.48, which is lower than the average PE ratio of its industry, the semiconductors and semiconductor equipment, of 29.99. Additionally, its price to book ratio of 2.08 is also lower than the industry average of 5.65, indicating that the stock may be undervalued. In terms of the company's recent news and trends, Daco New Energy Corp announced on April 7, 2021, that it had signed a long-term, high-purity polysilicon supply agreement with a leading solar wafer company. This agreement could contribute to the company's revenue growth in the coming years as the demand for solar energy continues to rise globally. Overall, based on the lower PE and price to book ratios and the recent supply agreement, we felt that Daco New Energy Corp had potential for growth and added it to our portfolio. We invested in Yum China Holdings, or its ticker symbol YUMC, because of its strong position in the Chinese market. Despite the ongoing trade tensions between the US and China, Yum China has been able to weather the storm and deliver strong financial results. The company operates over 10,000 restaurants in China under various brands including KFC, Pizza Hut, and Taco Bell. Yum China has a forward PE ratio of 25.63, which is lower than the industry average of 26.96. The company also has a price to book ratio of 7.31, which is higher than the industry average of 6.02, indicating that the market has a positive outlook on the company's growth prospects. Finally, we invested in Lichin China Limited, or LICN, as its ticker symbol because, like YUMC, the Chinese economy is expected to continue to grow in the coming years, but at a slower pace than in the past due to structural changes and external factors such as the ongoing trade tensions with the US. Even though the tensions are still high between the two countries, they still continue to negotiate on trade issues such as market access, subsidies, and intellectual property protection. LICN has a price to earnings ratio of 9.9, which is lower than the industry average of 21.9. Its price to book ratio is 2, which is lower than the industry average of 2.6. This means that the company's stock is undervalued compared to its peers. Although, it is important to note that a low PB ratio doesn't mean that the stock is a good investment. There are other factors that need to be considered, such as the company's financial growth, or the company's financial health, growth prospects, and its competitive position before making any investment decisions. Overall, we chose to invest in these companies based on their strong financials and growth prospects. The ongoing economic recovery, low interest rates, and government stimulus have all helped to support the stock market's performance. However, it is important to note that there are still risks and uncertainties, including the ongoing pandemic and geopolitical tensions. As such, we will continue to monitor the market and individual company performances closely. If necessary, we may consider selling some of the positions if the company's financials deteriorate or if there are significant market downturns. Alternatively, we may also consider buying more shares of these companies or other companies with strong fundamentals if there are attractive buying opportunities.